My guest today, Moritz Seibert, founder, CEO, Takahē Capital. Guess what we're talking? Trend following, ladies and gentlemen, a topic that I enjoy, a topic that Moritz enjoys. Without any further delay, let's jump right into it. I hope you enjoy.
In this trend following world, this world that I exist in, this world that you exist in, we all kind of learned who the legends were, the market wizards books, many of the people that were in my books, people like John W. Henry, Bill Dunn, that were not in the market wizards books. But, these guys were all swinging for the fences, making big money when the opportunities came, when the trends appeared in markets they could never predict. But the strategy was predicated on something big. You couldn't predict what's going to happen, didn't know the timing, and some particular trends started to happen, you had to take advantage of it. And I say this with no disrespect, more power to you for all the businesses that have gathered significant assets under the trend following umbrella. But we're at a crossroads, in my opinion. We've got all the legendary foundation, but in this new world, people are shooting for a different style of return. And when you shoot for a different style of return, are you not changing the strategy?
Not taking any risks in life is the biggest risk that you can take, as silly as that may sound. But when the CTA industry, and I'm too young to go back to the starts of that industry, looking at the data, which doesn't lie, when the CTA industry started with Dunn and Bill Dries was trading, they were all trading at 25 to 30, 35% volatility. This was kind of the norm. The earlier CTA, Dave Drews, I've mentioned Dunn, I've mentioned Dries, they were all at that kind of level. To me, that makes sense because you're trading a strategy where you take an appropriate amount of risk, not reckless, not irresponsible. And you do this because you want to make a lot of money. And then something changed. I think we can date this back probably to the year around 2000, around the change of the millennium, when all of a sudden it's like, oh my gracious, 20% volatility, 25% volatility, that is far too high. I can't really work with that. It is far too erratic. It has too much of a risk of a drawdown. Please give me something that is smooth and steady eddy, something like 8 to 10% volatility. That was because of institutional investors' demands, where you have different decision makers at the lever. It's like an allocator that receives a paycheck. They don't want to make a stupid or silly mistake by giving money to a higher volatility CTA that may have a double-digit down month or go into a 40% drawdown or something like that because it may risk their job. The CTAs quite luckily, or they quite happily responded to that. They lowered their volatilities. In aggregate, we can look at the data. You can look at the Soc Gen CTA index. You can look at the benchmarks, but you can also look at the individual managers, and you can see that they've almost all, not all of them, but 99% of CTAs have come down with their volatility to these type of levels, which meant that they could scale their business into the billions, which is fantastic for them because it just puts more emphasis on the management fee as opposed to the performance fee, which personally I think is absolutely wrong. I think our business should be performance fee based and not management fee based. And so they scaled into the billions, and the allocators were happy because they got a low volatility return profile, and the CTAs were happy because they had more money under management. But it's kind of like something has to give. And the thing that gives is the raw return. People became Sharpe ratio focused. They forget about the fact that you can't really have Sharpe ratio for breakfast. The only thing that buys you breakfast is the money. I just observed that change, and it hasn't come back. We don't even have to put this into the CTA box. It applies to almost every asset. Equities used to have 20% volatility. The S&P had 20% volatility, and everybody was fine with it in the 1990s. And then all of a sudden, this was too much. You can't have S&P with 20% volatility. You need to have it with 10. So please dial everything down and make it smooth. For a strategy that keeps losses small and lets winning trades run, that is already based on the foundation to protect your left tail, is, in my personal opinion, the wrong approach. Especially, we don't need all the money. We have most of our money in T-bills, and we need some of it to pay margin at the clearinghouse. So a higher volatility trend following setup is also more cash efficient. It's more risk efficient.
That early 2000s time period we're coming off trend following performance in 98, which was really good, 2002, which was really good, of course, 2008, which is in a way where the allocators saying, even though you've been successful, we don't want it.
You've been doing something wrong if you made money in October 2008. That type of period, we don't want that.
I think it was Ben Stein, maybe other people said it, that if you made money in October 2008, you were doing something wrong. Isn't that a great line? If you and I were to say to the audience, but we can give you verified data across untold numbers of traders who made money in October of 2008, not by predicting anything, every smart young guy out there should say, you know what? Let me prove that to myself. Let me go Richard Feynman. Let me hack this thing out. Let me go work it. Let me run the numbers, right? It's such an interesting space to be in with trend following, because I find after all these years for me, I still don't see the curiosity there, which is leading to another issue I'll bring up in a second. But the curiosity as to why this works, which gets back to my question to you, that if you crank down the volatility, which so many allocators are doing, aren't you changing the strategy? You're changing it. If you're saying we don't want that potential upside, I get that they don't want the downside, but they're also saying they don't want the upside, which changes the whole dynamic of the strategy.
I agree, because the strategy, the classic or the core premise of the strategy is built on taking an appropriately sized bet, getting out if it goes against you, keeping losses small and letting winners run for as long as it takes. And we can't forecast wherever these trades go. Outlier trades, cocoa and coffee and orange juice and all these examples. There's many more in the historical track record. I think this is the right approach. Take these risks, don't be reckless, but allow them to become big, and allow these trades also to become concentrated parts of your portfolio. Don't dial them down. If you respond to the trade becoming profitable, because think of cocoa, for example, right? You start the trade at a level of $3,000 per ton. It goes to $12,000 a ton, so it has 4x'd. The notional value of one futures contract is now 4 times as large. If you keep the same number of contracts in your portfolio, obviously that trade has now a much bigger footprint relative to other trades that have not performed as well. So ask yourself the question, is that something that you allow the trade to do or not? In our case, we like that because, yes, we accept the fact that cocoa now has this bigger footprint. It is moving the portfolio, but we're sitting on a big winning trade. That trade has produced a tremendous amount of open trade equity, unrealized profits. And that is essentially somebody else's money because it's a clearinghouse. We've been booked, we've been credited variation margin from somebody else who has had the opposing position in that same futures market, sitting at a loss. We're very liberal with other people's money when we play the markets. But if it's our own money and it eats into our core equity, then we get out quickly. Think about it, Mike. If you dial down that trade because it's become too big or because it's become too volatile, then the only thing that you do, or what you must do, is you need to sell futures contracts. You need to reduce that position. That is a profit-taking trade. That is a hidden mean reversion trade. That is the opposite of trend following, where you're supposed to let winning trades run on.
Do allocators know they're doing this? Do you think conceptually they know they're doing this, or do they sit there on high with 10 PhDs behind their name and they just unilaterally say, we can just do this?
I don't have the answer to that, but I know it's happening. Like, it's this big thing across the industry where you dynamically change your portfolio in response to changing volatilities and correlations. And in our case, when we do a sum total across all these trades, like we flag them as like dynamic position sizing trade or some sort of a overlay adjustment trade that is essentially an overlay to an already extremely good, robust trend following system, the sum total of these trades is a negative for us. They don't work. And you pay commission and you pay bid offer and you have slippage and all that type of stuff. Yes, what we do get is a smoother day-to-day, month-to-month return stream, more like to a target, not laser pointed. But yes, you can use that technique if you say, I want to produce 10% volatility kind of every month. That's not our aim. We don't care if we have 15% vol in one month and 25% vol in another month. It could happen. But the folks that want to have a constant 15% volatility, the only thing that they can do to get to that level is to dynamically change their position sizes up and down. And that overlay, it essentially is an overlay to an existing robust trend following system that exists since decades, as you know. That to me is not a good fit. It's just not a good marriage with trend following.
You brought up cocoa, and for people that don't know, cocoa was a fantastic trade in 2024. Absolutely amazing. Go look at the charts, go look at the data. But I think something that's really lurking in this conversation about the allocators, the people that control the pension funds and the endowments, et cetera, and they say, we want to give an allocation of money to the trend following world. We had this moment in time in 2002. We had this moment in time in 2008 where equity markets puked. Equity markets were not happy at the beginning of COVID, but there was a lot of magic wand waving and whatnot. And wham, bam, thank you, ma'am, we're right back to all-time highs. The interesting thing for the allocators, and they don't necessarily care because it's all relative to them. I mean, if all their friends are doing bad, when a bad time happens, why do they care? It's all relative comparisons, right? But I think what's interesting for the individual out there is to think ahead and say, well, we had this moment in 2002, equity markets bottoming out. We had this moment in 2008 with essentially a crash. And now it's 2025. And we've got boomers that are in this very large demographic with lots of money. It goes without saying, all one has to do is peek at the news occasionally to see that the narratives are entirely different. So I just wonder, how could the smart people at the allocators not imagine that we could have the equity market dislocations again? And historically, when we have had these equity market dislocations, there is one particular strategy, the one that you and I are talking about today, that does exceptionally well.
You definitely cannot discount these probabilities to zero. You can't discount anything to zero, as far as I'm concerned, in the markets. Stuff happens. Black Monday, 1987. Yes, it hasn't repeated in that fashion since that day, but we've had a flash crash, I think, in 2010 in the S&P 500. I definitely would not bet against another Black Monday at some point in time. I'm not betting against not seeing a 50, 60, 70, 80% drawdown in the S&P 500 at some point in time. It can happen. Maybe we should say it will happen. We just don't know when. So you have to be prepared for that. This is our strategy. This is what that system does for us automatically. We'd be getting out of a long position if we had one because we have give back or we go into the initial stop. And if the trend to the downside is strong enough, then guess what? We'll be opening a short position and we don't overthink it.
How will the watered down trend following do in a similar type equity market meltdown as 73, 74, or summer of 98, or 2002, or 2008? That's an interesting thought too. Will you have trend following performance?
We don't exactly know how the market patterns are going to be playing out in the future.
Not necessarily market patterns. What I mean is the, quote, less volatility trend following, how it might perform during a comparable equity market period.
How much bang for the buck do you want? This is an interesting question. Most people, unlike maybe you and I, who are 100% trend following, they view trend following as a component of their portfolio of stocks and bonds and 60-40 and risk parity and all the other things that they have there. Now, the protective characteristics which trend following can have, there's not a guarantee that it's not a hedge, but there is a tendency for trend following strategies, as we've just said, to start working really well during times of stress. When everything else in your portfolio is red, trend following has a tendency to become that beacon of green. Now, how much green do you want when you are going into a 50% S&P drawdown? You want quite a bit of green. In essence, you want a higher octane trend following version so that you can really have some balancing effect in your portfolio. If you have a CTA system trading at 8% volatility, steady Eddy vol control during these times, it's not going to make you 100%. A manager such as Mulvaney or Dunn or Dries or Tactical Dave Drews or us, Takahē. I'm not saying that we will, but at least we're positioned in such a way that we could. And that is important.
Let me keep you at a word that you have used many times. I know it's habit. I know it is industry jargon. I'm not sure what percentage of regular investors know the term. CTA, Commodity Trading Advisor, a term of regulatory meaning from the United States government. It is a broad term that can include any strategy where trading futures primarily, and I've beat this horse for a very long time, this term can include many different types of strategies. I would say, though, for those listening, to keep in mind that the word CTA can be synonymous with trend following. However, it cannot be, meaning there are people out there, there are firms out there, funds out there that will call themselves CTAs, and their strategy may have absolutely nothing to do with trend following.
Very good points. I'm as guilty as probably most people using that term over and over and over again. But yes, you can have CTAs, trading mean reversion on the S&P 500, or scalping the WTI crude oil futures contracts, which has nothing to do with systematic, diversified, long-term trend following trading, which is probably the box or probably the name that we should be using, but it's a longer name. CTA just is convenient.
Back to the core issue. Let's talk about mindset, because here I'm Gen X, you're Gen X. We've got, frankly, I guess a lot of the most successful trend following traders of the last many decades were boomers. But Bitcoin and crypto is interesting because at the same time, you have the allocators saying, we only want XYZ volatility. You have an entirely different appetite for risk, an entirely different subset of investors that are saying, no, we want the home runs. We want the big money, which would have been the same kind of mindset that Bill Dunn would have been raising assets. I mean, it would have been those kinds of people, no Bitcoin in the 70s, but I would think those types of appetites would have been the foundation for so many of the legendary trend following traders that we've all come to understand. And it's interesting that we've got these different appetites that are being thrust upon us. I'm not saying anything about the strategy of buying and holding any particular crypto. But then again, a lot of people have seen a lot of money made that way. Why do you speak to that issue, though? The mindset of these different types of investors and perhaps how that's come to be or come to happen? Because I think before crypto, there was probably that 10-year period in the early thousands where it didn't feel like, especially around the Great Recession, that people wanted big returns anymore. Crypto came along and it sure proved that a lot of people want big returns.
I'm really surprised by that as well, especially during the past, say, 15 years, where in many parts of the world, interest rates were really low, if not negative. So you have this period in Europe and Germany, for example, where interest rates were negative. In Japan, they were negative. At least to me, that would be the period where you would go, hey, I need to make some big returns because nothing else really is available. People didn't go for that. They wanted 3, 4, 5%, and they were happy with that. Now, you have all this hidden inflation, all that type of stuff. But to me personally, I'm here sitting in front of the computer. I'm doing what I love doing, but I do it to make money, and it has to be more than 5% a year. Now, the flip side of that is there can be years where it's negative 15 or negative 20. There are years where it's plus 35 or plus 50. But over the longer run, the CAGR of what we want to do needs to be substantially higher than 5%. Otherwise, I should be looking for a different job.
To keep it at the moment, talking about assets under management, it is worth bringing up that a significant number of trend following traders, or at least traders that built their foundations on trend following performance and perhaps raise their assets off that, are doing, again, the low volatility approach. I wonder how that kind of shakes out over the very long haul. I completely salute anyone that builds a business and says, hey, I've got this fantastic track record. I'd love for you to invest in me. But then the strategy changes. I'm going to be the person that's always going to beat the drum. I'll have a conversation with anybody on this podcast. I will speak with any trader in the trend following space predominantly. But I don't know what to say once the strategy changes. There's got to be a tent pole that we all agree that this is this thing, this amazing thing, this amazing idea, these set of rules, these techniques, these systems that were discovered, and they seem to be timeless. And they're predicated off human psychology. They're predicated off supply and demand. I just don't know what to do with the fact once it all starts to become something else. And I think you kind of hinted at this with me when we were communicating before the conversation, which is, and you've already said it in the conversation about 99%, maybe not going the perspective that you and I would prefer. What happens into the future? Will there be the trend following traders publicly stating what you and I agree with, or will it just become kind of some marketing stuff out there where no one really knows what the truth is anymore?
It's a lot of marketing, 95% systematic, 5% discretionary. It's the desire to cater to the concerns of investors, such as, can you give me a regime identification filter? Because trend following trading is so hard, as you know, like psychologically difficult, painful at times, because you have substantially more losing trades than winning trades. Nobody loves that, right? You need to have that thick skin to work with that system. It's very tempting to put a lot of research effort into finding the aspirin or the ibuprofen pill that takes care of that pain, makes that system better by removing these losing trades and making everything more palatable. So investors want that. They express that desire. And I'm not criticizing that managers try to find a solution and respond, because they're entrepreneurs. They want to build their business. But like you say, it does change the foundation of the strategy.
It also creates opportunity, though. I don't think we'd be talking right now if you didn't think it creates opportunity. If you have this fantastic strategy where other people say, let's water it down, it does create opportunity.
It's like it's back to the future in a way, because the opportunity is to essentially go back to where it started, because this is now the space that is relatively uncrowded. Think about Nash equilibrium, right? Game theory. We're all facing competition. If everybody is trading the 200-day breakout and everybody's trading the S&P 500 and everybody is doing vol control at between 10 and 12% volatility, then that is the very competitive red ocean space. And we have no business competing in that space. And in fact, it wouldn't be very smart to do it. But if there's only 3, 4, and honestly, Mike, there's not even a handful of these higher volatility, higher octane managers left standing, you and I know who they are, then maybe that is the much more attractive niche, especially if we can also be intellectually honest and say, you know what, we're not in the business of scaling. We're not in the ego business of scaling into the billions, which, you know, I think many fund managers, hedge fund managers, they have that desire to become a multi-billion-dollar fund. We don't have that. In fact, we have language in our legal offering documents that prevents us from going to that level. We have a hard stop at 500 million, but we'll be trading 500 million at a higher level of volatility. And that means that we can also go into the markets which are relatively smaller. They're not like the S&P 500. It's canola and orange juice and rapeseed and palm oil and power and freight. These type of markets.
These are markets that you have immense fundamental knowledge with, right?
Zero fundamental knowledge of Bitcoin. And all the other, like there's natural gas and power, these are all high volatility markets themselves. But if we apply a trend following system to them, then we can cope with their natural volatility by keeping losses small and letting the winning trades run. We don't necessarily care if a market is very volatile or not. This is a sweet spot for us, and not many are willing to operate in that field, because it means you're giving up on the institutional investor. The institutional investor is never going to be your friend. He's not going to be knocking on our door requesting a 25-30% volatility trend following strategy. They'd be freaking out. But we do have high net worth individuals, family offices, people that really understand the way we trade. And by the way, we have personal conversations with every single one of them. Nobody's allowed in the fund if they don't have a chat with us. We can also kick them out, by the way, if we don't like them. We just want to have this good fit between us and our investors. And we want them to understand in advance what it is that we're doing, and that they need to have some patience to experience that way of trading.
Help me work through what I'm going to put on the table. Boomers in America essentially got big time control in the 90s. Well, they got a boomer president in America. Boomers have been at so many key power levers in America. You'll have to tell me about Europe. I would assume it's probably comparable. And even today in America, the leaders. So if you think about it, presidential leadership in America has been boomer since the 90s. It's a very large population. And some of these great trend following traders that we all look up to were boomers. And a lot of their clients were boomers. So what's interesting is this particular generation does extremely well with these strategies. But as they kind of age and gain more power and more control, they're seemingly squeezing out other generations from experiencing the same opportunities. Why would boomers all want to have high vol trend following trading when they're in their youth? But then as they age, they wouldn't want to think that Gen X, Millennial, Gen Z, etc., would want the chance to get some of those bigger returns younger in life.
The cross-section of our investor base is actually, call them relatively young, younger than us. Maybe they've experienced Bitcoin or other things or the big tech stocks, but they kind of like get it. Like, I don't want to make an investment that will make me 4% per year. That just doesn't move the needle for them. Want something that at least can have the chance of making them big money. And when they look at the trend following managers across the databases and you just do a sorting function, you can go to any of these databases and sort them by KGAR, sort them by volatility, whatever your metric is, there really aren't that many left that have higher levels of volatility and therefore also higher returns. In fact, we've done the analysis, the median return or the average annual return, and obviously the average realized volatility of all our benchmark indices, the SocGen CTA index, the Beta 50 index, whatever you want to use there, it's all been down, down, down over the past decades. Volatilities have come down, returns have come down, and we don't want to swim in this pond.
They've come down, but we have no idea what's going to happen tomorrow. And so you need that strategy that's predicated on that. As you mentioned, new clients coming into your firm and implying that Gen X, Millennial, younger, would be interesting to know is for some of these very established trend following firms, many of which I've spoken with their owners and people that have educated me, fantastic early track records, salute their performance. But I wonder, what is their client base these days? Is their client base boomers? Maybe some still what they think is a taste of trend following, but dialed down. With the Bitcoin crypto backdrop, I can't imagine Gen X, Millennial, and Gen Z are saying, yo, I want to run into trend following at half vol.
In a way, Michael, it is logical. I'm not sure if they're boomers, but we can be pretty sure that their investors are institutional investors by and large. So you have the alligator mentality there. And their minimum ticket is 100 million or something like that. And if they're a sovereign wealth fund, they want to do even more, right? In a way, it is logical. We know who these firms are. And by the way, again, I'm not criticizing them. I salute them for the businesses that they have built. Amazing businesses, right? And if you and I were in their shoes, odds are we would have reacted in the same way.
100% true. I think anybody and everybody that's sitting in the shoes of a Winton or an Aspect or a Transtrend, Campbell, etc.
Great firms, and a lot of respect for them. And it is absolutely logical, in my opinion, if you have a business that runs on management fees. Once you've scaled into the billions and you've become this big behemoth with the 100 PhDs and the big DDQ and like everything that the institutional investor likes, and you have this nice return stream at between whatever 8 and 12% volatility that is, easy to digest. It's just logical to sit on that asset base and earn that management fee, because the management fee on a relative basis is now so much more valuable than the performance fee was at a lower level of AUM. The way I view the hedge fund space is that if you are a hedge fund, your job is to produce, call it alpha, a different return stream, a return stream that is not beta, that is not essentially cost-free. You ought to produce a return stream that is valuable, uncorrelated, different, based on skill. It can be discretionary, it can be systematic in our case, but it needs to be something valuable and different. If you're good at that job, you deserve to be paid an incentive fee or a performance fee, which aligns your interests with the interests of the investor. And if you fail at that task, and it's a hell of a job, you deserve to go out of business. But this is intellectually honest, I think, that in our business, you should be compensated based on that performance and based on the value that you provide to your clients' portfolios. And this is why we're charging 0% management fees. Our only compensation is a performance fee. And that needs to be above a hurdle rate, which is essentially T-bill hurdle rate. So that is a fair and true statement when we say that we're only going to be paid a fee if and when we make money for our clients that beats the rate of return on cash.
Bill Dunn inspiration there?
Yeah, I give credit to them. We came up with that as well, but they follow the same principle and they've been there before us.
Bill did it when you and I were little kids.
Yeah, in the 60s, it is the absolute 100% correct approach. Sometimes we get the feedbacks like, oh, we want you to earn a management fee, because if you don't earn a management fee with your type of strategy and you go into a period of drawdown and, it can be 1, 2, 3, 4, whatever years, then you'll go out of business because you don't have the management fee to support your business. My answer to that is, yeah, I don't know about this. Honestly, if you start in our line of work, you should have a little bit of, say, reserves to build your business for 2, 3 years. Like any business, 2 things can happen. Moritz gets run over by a bus. It's kind of like the key person risk. Okay, so if that happens, there's another team members I have. Hopefully they'll be in a position to continue with the business, but there's a key person risk clause. Hopefully the account will be at a new equity high. You get your money back. We're all trading liquid instruments, so no big deal. If we're failing to make money and we're going out of business because of underperformance or relative underperformance to peers, then we deserve to go out of business because apparently there's people who do a better job and there's better investment opportunities available for your money. So you should redeem your money from our fund. That then is likely the case because we won't be at a new equity high. We will be in a period of drawdown or something like that. And yes, we may run into some sort of financial stress because we depend purely on a performance fee. So again, you get your money back. It's liquid stuff and you'll have it back within 1 to 3 months. What's the big deal? I fail to understand the argument that sometimes is put forward that managers need to have a management fee because it provides stability for their business. Yes, but also for the investor. I don't get the investor thinking there.
Let me keep it at your point with the key person risk. This is something I never heard 20 years ago, right? And if you think about it, at the onset of anybody understanding what trend following is, it's typically one person looking in the mirror going, I know what this is. I'm going to do this. I'm going to become a trader for clients, a manager for clients. And so at that moment in time, there's a quote, key person risk. But look, if something happened to the key person, okay, they withdraw their money, they move on. But I think what's even more interesting about this singular person notion, as we talk about these very large funds that have grown to have, as you state, the billions under management, the 100 PhDs. A single trend following trader very well could have had a PhD. I know several of them. I know many that did not, right? But they all started as essentially one-man shops. The intellectual exercise to develop the system, to develop the discipline, to move forward, did not require the dog and pony show. It did not require all of this stuff. So if we're really, really, really being intellectually honest, we would say that, yeah, okay, we've got this massive firm now, but the reality is the strategy doesn't really require all this other stuff. The other stuff has been built up because we've got a successful, huge global hedge fund, and we're going to do our level-headed best to find additional alpha. And we want everyone to feel like we're an established bank, so to speak. But the vast majority of the success is based on these simple damn rules that go back to David Ricardo, Richard Donchian, etc. I mean, one can complicate this tremendously, but it's not complicated.
Dave Drews has a PhD. He's a medical doctor. He didn't have a staff of 10, I think. I know for a fact that Bill Dreise's CTA, Dreiss Research Corporation, I ran his trading desk for a while, so I was involved. It was essentially 2, 3 people. It was Bill and I was doing the trades. Definitely not 5. We used computers. We input the data. Technology gets better all the time. Python code, it runs, it's in the cloud. You don't need that many people to run a diversified, systematic trend following business. You just don't. There is no need for that. Maybe at some point you want to add one person that really understands regulations and all the legal stuff, because that becomes more and more and more and more. And it's definitely not the thing that I enjoy spending most of my time on. But do you need 10 people? No. For us, for our type of business, no, you don't.
And let's be honest too, some of the very, very large trend following firms, I mean, we're talking about massive profits. So in some sense, even with the staffs they've assembled, it's not a huge expense for them necessarily. I mean, they're still massively profitable. It's just always going to be fascinating for me, especially knowing from where so many of the biggest names started from. And I always go back to the commonalities, the similarities. You might have, as you mentioned, Dave Drews, Bill Dreiss, some examples. There's other folks that have multi-billions under management. I salute them all, but I will always do my level-headed best to bring it back to what's the core? What are we talking about? We are talking about this strategy called trend following. And yes, investors have a choice. They can say to themselves, I learned about this trend following thing. I'm going to give it a shot myself.
Yeah.
You know what? I have no desire to do the day-to-day, and I'm going to hire Moritz, right? It's this kind of simple world. It can get more complicated. Like me, I'm a small budget, so to speak, in terms of what my marketing message is. There's multi-billion-dollar funds out there filling the airwaves with other messages. That's all fair, but they're never going to defeat my core, honest, not saying anyone's dishonest. Here's the trend following, and this is the most amazing thing that still keeps me excited after all these years.
That is exactly our focus. And I think that is our competitive advantage as well. We're not charging management fees. We're in this higher volatility space of our industry. Not many people are there. We're catering to a different type of investor profile, maybe more the Gen X and Millennium people, and less the boomers. I don't know. This is what we're building a business on. And I find it incredibly enjoyable as well, especially because it frees me. Like, imagine we had like 20, 30 people or 40 people. You run this matrix organization, you're responsible for them. You have to give them something meaningful to do. Otherwise, they're unhappy. It wouldn't be fair of me to employ anyone and not give them a meaningful work and responsibility. But in our line of business, what do I want them to do all day long? We're not doing AI. We're not doing reversion trading. It's like Occam's razor.
They're paying for you to operate a high vol trend following firm. That's what they expect you to do. If they have an understanding of what that is, then they will appreciate everything you just said.
Yeah. And the less people we have, the more efficient we run our business, the more cost efficient we run our business, the better it is for the investor. It just means that we don't need to charge as much of, we charge zero anyways. Look at the multi-strat shops, pass-through fees. The salaries pass through, the Bloomberg terminal is passed through, a flight ticket is passed through. Well, I'm not putting my money there, for sure not.
It's just fascinating how things have unfolded.
They're definitely not high vol. I have not seen a multi-strat pot shop at kind of like 20% volatility. Gris Rokos has 20% volatility. Pierre Anderand has much higher volatility. And sometimes they have these big miss years and sometimes they have fantastic years. That to me is the better way of trading.
I'll give you a thought too. As long as you can, be the point person, be the speaker. I learned so much from listening to these early pioneers. Direct, the business development spokesperson out at an event in Chicago or London. It was Bill Dunn or Tom Basso. Those guys went out and hustled. I get it if there's massive success and it's not necessarily relevant anymore to large asset allocators. But I think for the conversation that you and I are having today, potential clients and investors in you are going to enjoy hearing more from you over time.
We have a zero salesperson policy at Takahē Capital. We don't employ one, and we're never going to employ one. We're not flooded with like thousands of investors requests per month anyways. The few that we get in our line of business during any given month, come on, I can have a 30-minute conversation with them and I'll enjoy it. And I want to get to know them anyways and see if they really get what it is that we're doing and if they understand the risks and the ups and downs and the pains and the pitfalls and all that type of stuff. I think that's good for me. It's good for them because it just gives me a chance to prevent that they're going to be a disappointed investor, because that's bad for them. That's bad for us. If they're unhappy, they'll redeem, or nobody's being helped with that. So no, we are representing my business partners, the other Moritz Seibert, who I think you've met as well. We represent the business. You speak to us. We just tell you how it is.
the most important thing as you bring me into your world and how you see opportunities and how you lay out the landscape. I mean, I stay so focused on strategy. I don't necessarily keep my finger to the pulse on the machinations of the industry. But I think the opportunity now, if one tries to be a historian for a second and look at capital flows, look at bond movements, look at equity market movements, look at assorted countries, look at where we've been over the last handful of decades, it just seems like a fantastic place to be. Trend following, that is. High volatility, traded as the pioneers traded it. A strategy that I could easily see, heck, it could happen this year, could happen next year. But I'm just saying is that it's easy to imagine, and I've said this in my trend following book, it's easy to imagine updating the book with the next series of meltdowns where everyone was questioning whether this high volatility trend following was really worth it. And then all of a sudden, equity markets from a buy and hold perspective are down 50% and trend volume's up 100% from a high vol perspective. I think the audience should be thinking about that. Imagine what could happen, even if we can't. Like, try to not just be trough drinking what they only tell you in the major media messaging.
Probability are all the things that could have possibly happened and not just the one instance that happened to materialize. We don't have the crystal ball between now and 2030 or 2035 or 2040. People are rumoring a Mar-a-Lago Accord. I mean, like, stuff will change in our world. Financial markets are going to be up and down and they're going to be volatile and nobody can forecast them. This is exactly why you say if you update your book in, say, 2030, it could be at a point in time where we're doing fantastically well. It could be at a point in time where we're just drifting along sideways.
I'll make sure to update it after a big run.
After a big run. So there you go. Selection bias. But the beauty of our strategy is, yeah, we can have these periods of drift or drifting lower because we're taking these small losses over and over and over again, but we're preventing killing ourselves and our portfolios with that way of trading. This is a form of resilience. It's a form of longevity for the strategy. It's universally applicable to all markets that are liquid, that we can trade. We don't necessarily care at all if it's Bitcoin or power or gas. They're all non-normal in their return distributions. They're all tailed on both sides of the distribution. That is what's so difficult for most investors to get to, because these tail events, they are these outlier moves. They're so crazy sometimes. They're so chaotic, and there's nothing that you could possibly forecast.
Your strategy is fond of catching those outlier moves when they do happen. I don't want to go there now because it'll just be a much longer conversation. If we were to ask general population, college educated, perhaps professional, what percentage of investors were aware of the idea of trend following? I don't think it's a large number.
Yeah, and also you've mentioned the outlier. By definition, once you have such an outlier price move and the chaotic price behavior, there's really nothing that you can do from a statistical perspective. You're missing sample size because there aren't that many of these massive instances that happen. So, but then to figure out, oh, I could be dialing down the position size or changing this or overlay this or filter this or regime identify this. If you are in that part of the return distribution where chaos looms, there's nothing that you can do other than just roll with the punches and enjoy the fact that you have kept your losses small. You're now out of the danger zone where you had this initial stop. You're somewhere sitting on open trade profits. Let's see what happens. Once you have these trades, very likely going to be winning trades. The question is just, how big is the winner going to be? And that cannot be forecast. So just let it rip. Be open-minded about these price excursions. One of the fallacies of human beings is you think everything is going to be around the mean in an orderly fashion, up, down, a few basis points in these markets. But no, be open-minded about the fact that you may be waking up tomorrow and the S&P could be down 10%.
How do you feel when you have to have a conversation like this, a touch more professorial, a touch more academic, and then you get the wild man me on the call?
You're not too wild. You're as wild as most of us are. But maybe the final point with all your books, great books, all the information that has been put out on systematic trend following trading. At Takahē, we're very open books about the way that we trade, almost down to the point where we're like, this is actually the system that we're using. Now, over all these years, I would have thought that people get their heads around it and they really kind of like genies out of the bottle. Everybody knows how these systems work. And to my surprise, that is not the case. Repeatedly, we're being asked, how do you size a position? What is this ATR thing? To our investors, like I said, we're completely open books, but I'm putting less and less of these things sometimes now out in the open because maybe it's still our secret sauce and I don't want too many people doing it.
I'm sure you felt this as Gen X. I've started to feel in the last couple of years. As you get a little bit older, you start to see your place. There's always another generation coming up that doesn't have the information, has not been exposed to some of the things that you and I have been exposed to. I think it's even harder because when I first got involved in this, it was in-person events or listening to audio cassettes that had been recorded of pioneers and raw data and magazine articles where you could tie what was being said in the article to exact performance. There was no BS. And if I saw BS, I would call it out. But I really loved the reporting of that age of the 90s and the early 2000s, post the Great Recession. Anybody can make any claim. And I'm still surprised that people don't look to the data. At least learn something, learn a lesson, figure out how things work by looking at the raw data that came before us. But maybe that's another thing also, that maybe some generations are not growing up with that scientific method approach, that skeptical approach, the Richard Feynman approach of let's go dig under the hood.
And staying in your circle of competence. I've alluded to earlier, we're not using AI or machine learning techniques.
If you are a high vol trend following trader, how would that stuff help you? On the margins, perhaps in some way, but it's not going to help you to catch that cocoa trade last year.
No, exactly. Like I said, I want to be open-minded about these things, but also very cognizant of the fact that that is currently way outside our circle of competence, and we're staying away from these hot air type of things. Oh yeah, we're using AI only because that pleases some investors who want to read about that stuff on our website. And if you don't use AI, you're kind of like old school. I only want to do these things if there is a statistical value add, if they really help us to make money and become better. And if that's not the case, we just stay away from it.
I'll leave you with this. Speaking of AI, you probably don't know that I'm actually AI now. This is no longer real. I'm completely 100% AI. I was talking to a video professional the other day, and he knows his stuff, and he assured me 6 to 12 months from now, AI Mike will be completely past the test and no one will know. I'm not sure I believe it, but we'll see.
Maybe that's true. Jerry Parker, he probably still says that the AI may very well learn to buy the 200-day breakout. That's when we're done with AI. It'll just do what we're already doing.
Hey, Moritz, your first got an interesting name, but where can we send people?
Takahē.capital, that is probably the best access point. You can contact us through the website. We're called Takahē because it's a flightless bird. Every couple of years, trend following is declared dead, extinct. It's no longer working. And the Takahē, South Island Takahē of New Zealand is one of the rare species that got declared extinct twice. And it always came back. It just moved to a higher altitude in the New Zealand mountain range where it could adapt better. It can't even fly, like I said, but it's still around. It refuses to go away, like trend following.
The website, though, just so people are catching the name, TAKAHE.capital.
Correct.
Moritz, cool stuff. We'll have to do this again.
Yep, we will. Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.